Yeah, thanks, Nishit. Good evening and a very warm welcome to Ceat's Q3 FY18 earnings call. I'm Anant and I have with me our CFO, Kumar Subbiah, here with me. I'll now take you through our performance. Our revenue from operations grew by 12% on a year-on-year basis and 2.5% on a quarter-on-quarter basis, which stood at 1,550 crore for the quarter. Largely, this growth can be attributed to our continued growth in the passenger segments and some bounce back in growth in the commercial categories as well. Our replacement SBU continues to grow well with focus on passenger categories as we've been doing for the past few years. Growth in OEM segment was also strong with high growth rates in the two-wheeler LCV segment, and we expect continued good growth in this segment for the rest of the year too. Exports also has grown with passenger car radial tires being well accepted by our key international markets like Europe, Middle East, etc. The political situation in LATAM countries like Brazil has improved, leading to some steady flows of orders. On the other hand, currency devaluation in countries like Egypt, Pakistan, Afghanistan is having some adverse effect in exports to those countries. On the raw material front, prices have come down slightly versus Q2 of FY18. I'll now share a few highlights gone by for the quarter. I'm happy to share that Ceat has associated with one of the most prolific all-rounder women cricketers, Harmanpreet Kaur. This bat endorsement deal makes Harmanpreet a valuable addition to the team. Ceat, which already has the likes of Rohit Sharma, Ajinkya Rahane and Ishan Kishan on board. On the product front, we launched our premium motorcycle radial tires, which we call as the Zoom Rad X1 at India Bike Week in November 2017. The Zoom Rad X1 provides high performance up to speeds of 210 kilometers per hour for premium bikes in 200cc to 400cc range. On the OEM front, we also launched the Ceat Zoom D tires, which are part of the newly launched flagship scooter model by Honda Motorcycle and Scooter India, which is the Honda Grazia vehicle. And key features of this tire is the ability to provide high speed stability, better handling and superior grip. Some other activities we associated with Mahindra Adventures for Northeast India and Bhutan expeditions covering over 2,600 kilometers during these trips. With these updates for the quarter, I'll now hand over the call to our CFO, Kumar.
Thank you, Anand. Good evening, ladies and gentlemen. I'm happy to present the key financials for the quarter. Our Q3 full year 18 consolidated revenue from operations grew by about 3.4% quarter-on-quarter and 12.6% year-on-year, driven by strong volume growth. It stood at 1,574 crores versus 1,523 crores in Q2 and 1,398 crores in Q3 of last year. Our consolidated margins stood at 41.8% for Q3. It has expanded by about 240 basis points sequentially and by about 50 basis points over the same quarter last year. Our other expenses increased by 14.2%, broadly due to higher advertisement spend and expenses relating to additional volumes that we produced during the quarter. Our consolidated EBITDA stood at 195 crores in Q3 full year 18 versus 181 crores in Q2 of the current year and 158 crores of the same quarter last year. The EBITDA margin stood at 12.4%, about 40 basis points improvement over the previous quarter. We continued our focus on working capital to unlock cash, and that helped to generate about 150 crores during the quarter. We used this cash to prepay high-cost loans to the tune of about 150 crores, and also the cash from operations helped us to reduce our short-term borrowings. Our overall debt came down by about 220 crores as of end December versus as of end September, which is from 1,020 crores to about 800 crores. We are also happy to inform you that the rating agency CARE has reaffirmed the credit rating of AA and A1+ with stable outlook. for the next 12 months. So our debt equity ratio consequent to a prepayment of debt has come down from around 0.4 to around 0.3 as of end December. With this, we'll now open the Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a few moments while the question queue assembles. Please press star and 1 on your touchtone telephone to ask a question. We have the first question from the line of Nitesh Sharma from Phillip Capital. Please go ahead.
Yeah, hi. Good evening, everyone. Thanks for the opportunity. So, Anand, my first question pertains to volume growth performance during the quarter. So, as we understand, our closest competitor MRF has grown at about 15% year-on-year in terms of volume growth. However, our growth was restricted at 7 to 8%. So, have we seen any sort of a market share loss in any of the segments during the quarter? If you could help us understand that.
Yeah, thanks, Nitish. I think largely, see, for us, what happened is that we've continued to grow well in the 2-3-wheeler segment. We grew at over double digits categories in 2-3-wheeler as well as the car categories. Our focus areas has seen good growth. I think one that the industry possibly faced was with anti-dumping duty for Chinese tires coming in August, September earlier this year. Certainly, commercial volumes would have gone up. At this point of largely utilized on our commercial capacity, so our truck radial capacity was pretty limited. We are fully utilized at that level. Even our bias capacity, which was underutilized, is now fully utilized. So largely, we are seeing that on the commercial side, it has picked up higher than the passenger side, possibly in the last quarter, whereas we've had some capacity. But 2-wheeler and passenger car has been pretty strong.
Could you help us with the replacement growth rate for 2-wheelers and passenger segment?
Approximately on average, double-digit growth.
So would it be like early teens or mid-teens?
Just you can look at it as double-digit.
Okay, not an issue. And have we seen any increase in aggression from MRF in the 2-wheeler segment of lately?
No, difficult to really comment on competitors' actions. I think I don't think across industry there has been any pricing action. So I'd say largely on the 2-wheeler side, we have seen overall good growth on the scooter side, whereas motorcycle has seen some challenge or the level of growth that we were growing at has slowed down a little bit on the motorcycle side. But largely, I would say otherwise things are quite okay.
Okay.
There are no internal issues that we are having, so I don't see any specific reasons for having lost any market share or anything on the motorcycle or scooter front. However, data is a little difficult to capture and therefore difficult to clearly say whether there has been a gain or loss in market share.
Okay, but otherwise no major increase in aggression by any of the players in terms of competitive intensity?
Not really. I think a few new players have gotten in the last, say, 6 to 9 months.
Right.
Besides that, nothing else.
Okay, great. And is the understanding correct that what you said, the TBV plant is currently operating at 100% utilization? That's what you highlighted?
Yes, close to 100%, our truck radius capacity.
So this started from December onwards or the entire quarter was 100%?
Approximately the entire quarter. Maybe from October, November, maybe from November. I don't have that data. But largely, I'd say for the last 2-3 months on average, we are fully utilized, at least.
Okay, great. Coming to the margins, we've seen a strong sequential improvement in gross margins. However, that was not reflected in EBITDA. So I understand that there are some startup costs relating to the new OTR plant. So could you help us understand what exactly led to the increase in other expenses during the quarter?
I think gross margin during the quarter moved up by about 40 basis points. and that is translated to EBITDA improvement also by 40 basis. Around 12% in the previous quarter. The last quarter was about 12%.
No, I'm talking about sequential improvement. If I look at quarter on quarter, there has been a 240 odd bips improvement in gross margins.
Okay. No, see, that is on account of other expenses have moved up, largely advertisement costs, and costs relating to production. So indirect expenses relating to production, it has moved up. And second is also Ambernath factory was started in sometime in October. Okay, so therefore slow ramp up of Ambernath factory has obviously had some impact on consolidated margins.
Okay, any additional cost because of Ambernath factory startup?
So Ambernath plant is anyways a small facility. The initial cost will be high with kind of a slow ramp up or slow capacity utilization initially. So that cost impact will certainly be there.
Okay.
It's a 40 ton per day plant. If you start off at 5, 6, 7, slowly go up to 10, 20. However, as you ramp up, initially it will of course be loss making. So that you have to incur.
Sure. And what is the outlook on the raw material front for the next quarter? How much inch up are you looking at in terms of RM?
I think largely if you see, rubber has been quite stable. In fact, it's come down a little bit in the recent few weeks. On the other hand, crude has really shot up to close to $70 level. So I say that if you look at a 3-month lag kind of time period, I say quarter 4, there may not be major fluctuation. However, we start feeling the impact from quarter 1 onwards of some amount of raw material. I say 50% of our raw material has gone up, 50% is stable or gone a little bit down. So that's how broadly I would kind of classify going forward in quarter 1. May not be more than about a 5-6% increase in quarter 1.
Okay, got it, sir. Thank you very much. I'll come back in the queue.
Thank you very much. We next have a question from Jay Kale from Elara Capital. Please go ahead.
Yeah, thanks for taking my question. So my first question was regarding your volume growth again. We had a low base of last year demonetization, and we've seen the two-wheeler industry OEM also grown in double digits. So I was just wondering, in the replacement side, I think the demonetization impact was a little higher. So from a volume growth perspective, if your overall volume growth is around that 7%, then which other segments would have declined heavily? Was it the commercial vehicle where you also said that it has bounced back in Q3? So if you can just tell me, highlight which are the segments which have been relatively much weaker to get a 7% kind of a volume growth?
Yeah, I think last year the low actually is a little bit of a misnomer, a little bit, because I'd say that all the way till early December, sale was pretty okay. Despite demonetization happening on November 9th, I'd say sales continued to be as per normal levels. And FY17 growth over FY16 for quarter 3 would be at above 10% volume growth levels. So actually, if you look at it from a growth perspective, last year was not too much of a low base. Secondly, if you look at category-wise basis, as I said, areas where there have been slower growth is largely in categories we've not been focused on, things like on the tractor side or the last mile category, etc. But our focus areas of two-wheeler, passenger car have been good. And as I said, on the truck side, things started to pick up in the later part of the quarter. There's been growth, but we've been a little bit limited from a capacity front.
Okay, so would you expect that, the larger portion of the base effect was felt more in 4Q in the replacement market, and hence you would expect a better Q4 in terms of volume growth?
Yeah, I wouldn't want to predict on Q4, but I would rather say that at least in quarter 3, we grew at over 10% year-on-year basis over quarter 3 of the previous year. So in that effect, actually the low base is not there. When you saw a lot of, say for example, OEMs, etc. showing -20%, -10%, for us, tire sales grew at about 10%.
And in terms of the OEM, if you could just highlight, has there been any, market share movement from your OEM two-wheeler side because of new players entering, or the share of business has been largely stable?
So share of business has been stable because even the new players who enter, they announce capacities. By the time one announces capacities, they come into effect. You have to get OEM approval. OEM approvals very often take a year, year and a half, 2 years time, etc. And very often when new people get in, I guess it is natural for people to initially focus on the replacement segment because that is more profitable. So right now I don't see any impact on OEM sales by anyone. OEM sales continues to be strong.
Okay. And in terms of the capex, if you can just highlight what would be the capex for FY18 and 19? Does that earlier guidance stand?
Okay, FY18, we are likely to incur about 500 crores. 450 to 500 crores is what is likely to happen. In the next year, it could be in the range of 1500 to 1700 crores. That is the range.
In FY19, it will be 1500 crores. Sorry, if you can just repeat that.
Sorry, what is it?
FY19 capex. If I just missed the FY19 capex.
It would be in the range of 1500 to 1700 crores.
Okay, great. Thanks and all the best.
Thank you very much. We now have a question from the line of Mr. Nishit Jalan from Kotak Securities Limited.
Hi, thank you for my question. Sir, have you increased your capex guidance significantly? Because if I remember correctly, we were talking about 1,000 crores in the last call. Is it that you are trying to get your capacity early because of constraint in certain segments that you have highlighted?
No, see, if you look at the previous calls, we had indicated a higher capex for the current year. And 700 crores to 800 crores is what I had indicated for current year, and next year about 1,000 crores odd. That's what we had indicated. But this year we are likely to be in the range of 400 to 500. Okay, so the 200 to 300 crores of this year is likely to move to the next year, and the balance is the next year.
Okay. So my second question is, you mentioned that we have seen new players coming into the two-wheeler segment. So what kind of pricing strategy are you seeing from those players? Because are they trying to basically keep lower prices and get volumes, or that kind of pressure are you seeing in the market, particularly from the newer players, not from the incumbents?
No, we are not really seeing yet any impact, because even if you look at the newer players, I mean, in some cases it was an acquired capacity, so there was no real increase in capacity. And we don't see much of a pricing game. Relatively, it's a branded product, and the volumes being so low, today if there's somebody who's, making 10% of what we are making, in that kind of a situation, we won't react to that kind of a pricing decision made by that player. For us, it will be more that if the top 1 or 2 players take pricing decisions, we may try to react. So it doesn't affect our pricing strategy.
So that I agree, but are you seeing any such step being taken by smaller players?
No.
Okay. Sir, we have gathered that there has been some pricing action in terms of increases in the commercial vehicle side from 1 or 2 big players. Just wanted to confirm, have you taken any pricing action in commercial vehicle or any other segment? Because now we will gradually start to see RM pressure coming in from 1Q that you have highlighted.
No, we've not taken any pricing action.
Okay. So my last question is, in the presentation you mentioned that working capital has come down. So is there some one-off related to that, or basically what has changed? Have we changed our RM procurement policy in terms of keeping lower inventory, or the debtor days have kind of come down? Is there anything structural, or there is some specific reason to that?
No, see, there has been overall reduction in working capital. We focused on working capital right from the beginning of the year. We held a little more inventory as of 31st March last year also, because we bought more natural rubber from the local market. Okay, there has been all-round improvement on stocks, receivables, and creditors. So that's broadly, and as far as last quarter was concerned, it was a combination of inventory and the creditors.
So that is sustainable in that sense?
No, it's sustainable at the current level. From now onwards, okay, we need to see whether you would be able to get that kind of reduction.
Okay, thanks.
Thank you very much. We have the next question from the line of Ashutosh Tiwari from Equirus. Please go ahead. Mr. Ashutosh Tiwari, please go ahead with your question.
Yeah. So you mentioned that in TB we are operating at almost full utilization level. Is same the case with TBR also?
Yeah, so I think more on the TBR side, in fact, we are operating at full capacity. TBB, what happens is that suddenly when there's an increase or surge of demand, it's sometimes difficult to meet the full capacity in a short period of time. So we are operating at near full capacity kind of a situation to whatever maximum we could have produced. So that ramp up sometimes takes time even of a underutilized plant.
Okay. So our expansion.
There is still some scope of taking capacity up marginally, but these are all minor operational debottlenecking opportunities. You know, we sell about a little bit over 1 lakh tires. So we're talking about say 5,000 tires more. Is where that kind of number opportunity that is there through kind of training or getting back some manpower to ramp up the plants.
Okay, and when will our expansion come through, the TBR expansion that we have planned?
In Q3 of next financial year. Q2, Q3. Sorry, Q3. October, December quarter, that's right.
Okay, so that means that over next 2-3 quarters, the volume growth in truck segment for us will be quite low.
Yes, growth-wise, there will be a little bit of constraint.
Okay, and do we produce LCV also from some LCV tires on the same line, or there's a different?
Same situation.
Okay, so almost 45% of our volumes sales basically will have a lower growth over next 2-3 quarters.
Yes, on quarter, it will not grow at a high clip.
Okay, and sir, how was the progress on the four-wheeler side? I mean, have we reached the full utilization level at Halol?
Full capacity at Halol? Yes, so there is still a potential for further growth on the passenger car side. Utilization levels are good and we are happy with the ramp up that is happening. We are also growing well on the passenger, so there is growth opportunity of say another 20%, at least to 20 to 25% more opportunity for growth in the passenger car space, passenger and UV space.
Okay, and in the Nagpur, how is the progress in terms of capacity right now?
Yeah, Nagpur also capacity expansion is coming along well. We are happy with the progress as well as the OEM approvals that we are getting in Nagpur, and there is further space for growth in Nagpur as well at this point of time.
Okay, but what level we are currently out of 120 that we have planned earlier?
Out of 120, we are close to about 50-60% capacity utilization levels today.
Okay, and sir, I mean, we already have gained quite a bit of market share in two-wheelers in replacement, and OEM also I think is the market share is on the same level as replacement. So, do we think that now also there is scope for a good amount of expansion in the market share, or that's really tough to come by because other players also are trying to expand in two-wheelers?
I think the pace of market share increase that we've grown in the last 4-5 years, say from 10-15% to 30%, that kind of growth, of course, I think is looking challenging. But on the market side, market has been quite robust. Two-wheeler growth has been good in the OEM side. So that will reflect on the passenger side going forward. In addition to that, market share growth potential is there. But of course, maybe say from today's somewhere around 26 to 30% levels today to going up to 35%, that's certainly something that we are aiming for.
And sir, lastly on the specialty tire plant, how's the progress and how's the customer trials and all going basically? And what's the volume that we are looking at say next year?
Yeah, so it's a 40 ton per day plant. We had set up the plant sometime around June, July. There were delays with respect to consent to operate from the Maharashtra government, which we finally got around middle of October. Since then, we've been ramping up and we are happy. The good thing is that the product testing has happened and the feedback on the products are excellent. And therefore, we're going to be going ahead with full speed ramp up as well as sales. For 40 tons per day, I would say another 6 to 8 months for close to full utilization. I think in the end, it is a little bit about sales also picking up. So from a productionability side, I think we'll be able to produce that. Sales, we have to still wait and watch because it's a new product, new markets for us. So we will aim for reaching full capacity by the end of this year. end of the next financial year for sure, and look at a further expansion going forward as planned.
Okay. Okay, sir. Thanks a lot.
Thank you very much, ladies and gentlemen. In the interest of time, we request you to limit yourselves to 2 questions per participant. You may rejoin the queue at the end of the 2 questions. Thank you. We have the next question from the line of Mr. Mayur Milak from India Nivesh Securities. Please go ahead.
Yeah, hi. Anand, so just one thing on your capex plans. So at one point I was just looking, so we are typically making an operational cash flow of about 800 odd crores, and we're looking at a capex of about 1500 crore. So this gap of this 700 crore, are we really looking at getting this money through debt, or how does it go?
Oh, see, the total capex for the next year would be a combination of debt and equity. And so to the extent of internal accruals, we would certainly utilize it. That would be our priority number 1. And balance would be funded through debt. In few cases, even during our negotiations, even vendors have agreed to provide a slightly longer credit period. So it will be a combination of all 3.
Okay, because I heard you say that you've repaid debt in the current year to the tune of about 200 crore, is it?
Yeah, in the current year we prepaid about 230 crores. Okay, in the earlier quarter we had paid about 100, and the last quarter about 130. So 230. Yes. Yeah,
we've paid 300 crore, 230 crore in this year, and then we're looking to pick up. So there will be a gap of about 600 crore, which really needs to be addressed through debt and creditor funding is what you're really saying, because the best that we could probably generate out of operating activities would be in the range of 800 to 900 odd crores.
Yeah, operation generation will be little lower than what you indicated. Yeah, but your point is, agree with your point. We will have to fund it through debt, the balance portion.
All right. Thank you so much.
Thank you very much. We have the next question from the line of Chirag Shah from Edelweiss. Please go ahead.
The opportunity. Anand, first question I have is a housekeeping one on the revenue mix that you generally share.
Yes.
So can you just share the revenue mix in terms of truck and bus, two-wheeler, three-wheeler, LCV, car UV, and that form that you share? It's not there in the presentation. I couldn't find in the presentation.
Yeah, I think that we've taken a call to share it on a half-yearly basis.
Okay, so you're not willing to share it quarterly now?
Yeah. But similar trend, broadly coming along as per whatever we were doing.
Okay. Second question was on the capex side again. So I see the press release where we have ramped up, we have increased your 5-year capex by around approx 700 crores.
Yes.
So can you just share some thoughts over there? And it's on the passenger vehicle side.
Yeah, that's on the PCR side.
Yeah.
So we feel that we've been growing pretty well. We are happy with our growth. Also with respect to future demand, we see a need for further expansion larger than what we had planned. While the plant is not up, we feel we need a larger plant, and that's the basis on which we've kind of set up this new capex approval.
And again, it will get front-ended in the sense the extended capex versus earlier that we had. Is it because of this increase in capacity, the new plant that you are setting up is much bigger in size than what were earlier envisaged?
So what we had planned was it would happen in different phases. So generally you buy land for, of course, something which is much larger and it expands over a period, just the way Halol we acquired and started in 2008, and we are still expanding 10 years later. That's how we had planned it. So to that extent, it's just a phasing which we brought back a part of, say, a phase 2 to phase 1.
Fair point. And one last question on the funding of this. So you indicated that you have paid high cost debt. So what is the differential that you are looking at in terms of savings? Because you have paid 200-300 crores of debt and then you again borrow similar amount next year. So how big the differential will be? Will it be 5-6% differential in terms of interest rate saving that you have?
No, it's not so large. Okay. First of all, we generated cash from the operations, and we also generated some cash through better working capital management.
Yeah.
These loans, we had a window of opportunity to prepay 2-3 of them during the course of the last year, and so therefore there was no immediate need for us to utilize that cash for capex. So therefore we utilize the existing cash generated to prepay loan, but the differential, if you were to compare it with short term versus long term, maybe about 1.5%. If you were to short term, I'm saying whatever is opportunity available. But if you were to compare it with what we would be paying when we borrow later, it may not. It will be much less than that. It will be about 0.5% approximately.
And one housekeeping question, if I can squeeze in. Tax rate has gone up, so how should we look at that number? Is it because of lower other income or something like that, or how should we look at that effective tax rate number? It's now almost 34% for us.
Okay, see, two things. One is that if you compare it with last year, the tax rate has gone up largely for two reasons. One is that deduction for R&D has come down from 200% to 150% under the Income Tax Act. Second one is that investment allowance that was available last year to the extent of 15% of investment is no longer there in the current year. If your comparison is current quarter versus last quarter, then broadly on account of lower R&D expenses during the Q3.
Okay, that's the primary. Yeah, so 33% is the average tax rate that we should work with going ahead, or it would be lower because of higher capex and other things. So for next year 19, what kind of tax rate that we should look at?
I think you should keep it at around that level, 32 to 33. See, we would be paying actual tax outflow, cash outflow would be lower.
Yeah.
Because of the reasons that you mentioned in terms of capex. But the difference between 33% and whatever the actual tax paid is nothing but deferred tax.
Yeah, fair point.
Which is not a cash flow, but it is part of our P&L.
Okay, great. This was really helpful. Thank you, and all the best.
Thank you.
Thank you very much. We have the next question from the line of Niket Shah from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. Just two questions. One is on the Octro and the LBT part of it, which was a benefit that we were supposed to get post GST. Would it be possible to quantify it or any clarity on that?
Yeah, no, I think that's something which has in a way gone away right now, but it kind of gets absorbed somewhere in the raw material prices. So difficult to quantify in that sense, the quantum of benefit that comes in, because.
But the benefit would have flowed in I mean, post GST would have obviously flowed in.
It will be part of raw material prices.
Got it. The second was on the custom duty increase which happened yesterday on the cross-ply tires from 10% to 15%. Does that significantly change the dynamics in the cross-ply part of the market, specifically on the truck and bus part of the segment?
Yeah, I think there was a custom duty increase on radial tires, not cross-ply truck and bus, radial tires.
Okay, I'll just check on that again.
So that
because I thought it was on cross-ply, so maybe my error on that side.
I think that certainly will help in terms of making Chinese tires a little bit, or imported tires a little bit more expensive. So to that extent, there should be some benefit coming in. On the other hand, there was also some increase in cess rates for raw materials. So that's an adverse impact that would have hit the industry or most importing industries.
Sure. Yeah. And the final question is on the debt side of it. What kind of peak debt are you looking at in FY19, and do you think FY19 the debt should peak out and then it should kind of start coming down in FY20?
Okay, see, as we stand today, debt equity has come down from 0.4 to 0.3. Okay.
Yeah.
It could be in the range of 0.7 to 0.8 in the coming year. Okay, it entirely depends on what is the exact cash outflow, how much we are able to manage with vendors, and what is our internal accrual. But that could be the peak.
So broadly, just to get it to numbers format, safe to assume about anywhere in the range of 17 to 1800 crore can be a peak debt number, or is that calculation wrong?
Higher over now.
No, see, the next 2 years would see increase in debt. Okay, because truck and bus radial tire plant would be commissioned in the coming year, so by then large part of the capex would be spent. Okay.
Right.
The following year, passenger car radial investment would have been completed, okay, including whatever we had announced yesterday. So
right.
In my view, I think the next year, FY20, would be the year of peak debt, and after that it will start coming down.
And FY20, what kind of capex numbers would one roughly work with? I mean, it's too early, but just a broad sense.
Okay, I'll give you a sense approximately.
Yeah.
It will be in the range of 600 to 800 crores.
600 to 800 crores. Perfect. Thank you so much, sir. Best of luck.
Thank you very much. We have the next question from the line of Pawan Kumar from Unify Capital. Please go ahead.
Sir, I just wanted to harp back on the raw material basket. What we have seen since on a year-on-year basis is definitely natural rubber seems to have come down, but definitely the rubber chemicals prices and even the carbon black prices seem to have shot up. So overall, I wanted a perspective from a medium-term perspective on raw materials. And secondly, from Q1, you said there is going to be some kind of raw material pressure. But I was wondering last year Q1, this year Q1, if I'm right, was the peak of rubber prices, right?
Yes, true.
Yeah. So I just wanted your perspective on the whole raw material basket as a whole.
Right. So as I shared with you, natural rubber has been relatively benign at this point, which means in the last, 1 month's time. And that will start hitting us that benefit will come in on the rubber side in quarter 1. On the other hand, crude has gone up, which is crude and crude derivative products are close to 45%, 50% of our total raw material basket. So in the end, the increase in crude will have a higher adverse effect. So net on a quarter-on-quarter basis, quarter 4 to quarter 1 or quarter 3 to quarter 1, we'll see a jump in raw material pricing. However, if you compare quarter 1 FY18 to quarter 1 FY19, it will not see a jump. So year on year, you will not see a jump, but quarter on quarter, there will be a jump, right?
Okay. So should we, am I right if I'm saying if it is 50% and 50%, then broadly your raw material prices basket should see an increase in range of 5 to 10%?
Approximately say around a 5% kind of from quarter 4 to quarter 1 or quarter 3 to quarter 1 approximately.
Okay.
Yeah.
And over a long-term trend, what is our expectation on rubber prices, sir? Do we expect them to broadly decline or increase, or how do we see that natural rubber?
Very difficult to predict that.
Okay. Okay. And regarding the 150 crores capex, whatever we are indicating, can you just broadly outline where we are investing?
It's a combination of 3. Okay, the large portion would be bus radial plant at Halol and passenger car. These 2 would be large. Balance would be in some specialty and 2-wheeler tires.
Okay. And should we see the full, at least a partial impact of Ambernath starting up, start reflecting in the numbers next year, FY19?
Yeah, so
maybe 50% capacity utilization.
I think so. See, it will have some adverse impact on consolidated results, maybe even for this quarter. Okay, because initial quarters they would be reporting some losses. As the capacity ramps up, you will see some impact in the quarter next year, FY19.
What broad range of break-even?
Mr. Kumar, since there are several people in the queue,
Fine, thanks.
Think you can rejoin.
For the response.
Thank you very much. We have the next question from the line of Gautam Trivedi from Nepean Capital. Please go ahead.
Yeah, hi, Anand, how are you? Quick question. First of all, congratulations on the Ambernath plant. I wanted to understand on the OHT segment, how much will be export versus domestic, and going forward on a 3 to 5 year basis, 3 to 5 year view rather, how big could this become in terms of percentage of revenues?
Yeah, so we will be exporting close to 100% from OHT tires. At least I'm talking about the new Ambernath capacity. There are some port and mining tires that we do sell in India, but that's been out of the past capacity that we've had. Going forward in the next 3 to 5 years, we expect this capacity to go up from about 40 tons per day to 100 tons per day. The next expansion from 40 to 100 will happen over the course of this year and a half quarters time, and that will ramp up in another year after that time.
Great. Thanks.
Yep, thanks.
Thank you very much. We have the next question from the line of Nitesh Sharma from Phillip Capital. Please go ahead.
Yeah, thanks again. Sir, on the Ambernath plant, so as we know, one of our competitors' margins is very healthy in the export, OST export he is present in. So should we expect similar kind of margins, or what sort of number are you looking at as far as margin goes for the OST plant?
Yeah, I don't see any reason why we should not be substantially far away from where they are. So at a range level, it should not be very different, because the model of that particular plant is not so different. There can be some difference because of scale impact or a brand impact, etc. But broadly should be range bound.
Okay, and in terms of markets, is Europe our key focus market?
Europe and US.
Okay, and what would be the break-even level for the Ambernath plant, if you could help us?
See, in terms of cash break-even would be 50% of our current capacity, a little higher than 60% of our current capacity, and at full capacity it should be a PBT. It will break even at PBT level.
At
the first phase.
At full utilization level.
Yeah, full means I'm talking about phase 1, 40 tons.
Okay, phase 1. So basically, even at full utilization, our margins will be very subdued as far as phase 1 goes.
In the initial year 1, yes. Okay, and once it ramps up beyond 40, then we'd start breaking. We'd start generating positive cash as well as positive profits.
Okay, got it. Thank you.
Thank you very much. We have the next question from the line of Rohit T from Valium Capital. Please go ahead.
Yeah, sir. Thanks a lot for the opportunity. Sir, we were talking about the expansion plans. So I would like to know what would be the capacity breakup segment-wise as of now and after expansion in the one that you said about the radial tires and the cross-ply tires.
So cross-ply will relatively remain. Of course, we are not expanding much more in cross-ply except for the two-wheeler segment. So,
yeah.
So if you look approximately today is what, about 30% radial and 60% cross-ply across category kind of breakup. This will of course reverse to approximately 60% radial, 30% cross-ply, approximately at that kind of level, because we see more growth in the passenger car radial and truck radial capacity, and no growth in truck bias, but some growth coming in two-wheeler bias. This is just approximate numbers.
Yeah. Thanks a lot for that. And my second question would be how much revenue are we expecting from the export market after expansion in next 1 to 2 years?
No, that we've not really calculated as such, but I would say approximately 15% or so of our sales will continue to be exported.
Acha, with a better margins than the domestic margins?
No, we don't share that data.
Yeah, that's fair enough. At the same time, I also want to